Number three, our topic for November 2025, rising concerns over stock market bubble. So, Albert Edwards, a name people in the markets know well, a global strategist at Société Générale, a French bank, which I'm sure Peter Isaacson knows well, and I suspect so do you, Glenn, quite a big bank. He has raised a red flag on the current state of the US equity market. He believes that the market, largely driven by tech and AI, is in the throes of a dangerous bubble. This could have dire consequences. Edwards points to soaring valuations of tech companies, some trading at 30 times forward earnings. This is a ridiculous figure. He also argues that consumer spending is being driven far more than usual by the top quintile of wealthy Americans. So the economy is actually more vulnerable than during previous bubbles. Our own managing partner, Sanjay Acharya, has been running the numbers. He has been warning about the concerning signals suggesting major economic difficulty. He's not the only one. Bank bosses to the International Monetary Fund are warning about stratospheric valuations of America's tech companies. I'll give you one figure, which JP Morgan Chase came up with. For a 10% return on AI capex, which is capital expenditure, projected by 2030, these companies will need $650 billion of annual AI revenues. That is the equivalent of $400 per year from every iPhone user. And a lot of investors believe that this is a ridiculous figure. Now, we think when you look at figures of debt, US debt will soon exceed that of Italy's and Greece. Italy's and Greece's for the first time in the 21st century. We know the dollar is depreciating. We know inflation is rising again. We know tariffs are starting to bite. Glenn, you were going to make that point about that lag factor of tariffs. Do so now before I carry on.
Right. Yeah, not only tariffs, but there's been a lot of comment about, gosh, the tariffs haven't had any effect, of course, which the Trump administration is saying, well, I told you everything would be perfect and, the sun would rise even at sunset. That's simply ignoring the fundamental facts that the smallest rise in interest rates, the shortest term interest rates, if you increase those rates, it takes about 6 months to see any effect in the economy. The longer term rates, bonds and so on, and Fed funds and all this that have terms of 5 and 10 years take about 18 months. Changes in fiscal policy don't affect the economy immediately. Changes in the tax rate, the monetary policy. It all takes from 6 to 18 months to start to show effect. That's only now. It's been 1 year since the president took office, since Trump took office.
Not quite. He took power in January. Not yet.
Well, not even a year.
January.
Correct. I'm sorry.
Yeah.
Not even a year. And it's only been, 5 months or something since he announced his incoherent and constantly changing, quote, policy, unquote. So nothing has really had a chance to affect directly, other than through fear and confusion, the fundamental factors of the economy. That is only now beginning to be the case. And in every case, every instance, you can take housing costs, unemployment rate, exchange rate, tariff rate, deficit size, construction investment, on and on and on and on and on. All of the indicators are bad, meaning that there are increasing strains in the economy and that a recession is increasingly likely.
Yes, and we send our FOI geopolitical risk monitor. We sent it out for November, and you can take a look at the numbers. Sanjay did a lot of data crunching, and yes, Glenn is right. Recent data does support the Trump administration views. Tariff revenue has jumped, but imports and exports have held steady. But that is, they are not recent data does not account for future data because of the time lag factor. Basically, our sources in the U.S. Treasury are worried. In fact, one of my dear friends who's retired from the U.S. Treasury has been really worried, and exactly along the same lines, exactly for the same reasons as Glenn. He says, number one, the tariffs as the Trump administration has imposed are not such a good idea. And number two, the arbitrary way in which they have been imposed are going to lead to decision paralysis at the CEO level, because you have no certainty. So how do you make all these business decisions, which basically you have to, all of these decisions play out over time, and that'll lead to uncertainty. Also, he worries about, and our sources in the Treasury, and this is, it's not rocket science. Everybody is worrying about the cost of living crisis and affordability issues, and demand. Let's assume even if the AI bubble was to take off, even if production went up miraculously, AI could produce things in plenty, pencils and notebooks. Let's assume the AI would optimize the distribution of everything. Even then, when you are getting rid of jobs, when Amazon is using robots instead of people, when you are seeing massive dislocation in the economy, you are in a situation similar to the 1920s, wherein there was a lot of boom, there were radio stocks and whatnot. But the big question is, where will the demand come from? Eventually, arguably, the economy will adjust, new jobs will emerge, yada, yada, but there is a lag factor there as well. And in between, obviously, we remember 1929, Andrew Ross Sorkin has written a book, 1989, which has basically become the rage in America. And so we are not being original. Everyone and their dog seems to be predicting a crash. But the reality of the matter is that the talk, just because there's a lot of talk about it, doesn't mean that it is all talk. It is a reality that we are waiting for Godot. We are waiting for a crash. And the University of Michigan regular tracking of consumer confidence for November came up with a score of 50.3, the second worst score ever. So on the whole, things are not looking good. And even when it comes to the dollar remains the currency of trade, but investors, central banks and treasuries are diversifying away from the currency. So multiple indicators point to a crashed stock market, high prices, weak employment, and a depreciating dollar. We've been very cheery.
The economy relies upon the average consumer fundamentally to grossly simplify. And what are the facts? That the stock market increase is 60% of the stock market's increase is attributable to the seven magnificent AI high-tech computer related firms. 40% of it is for the remainder of the stock market, which it's up, but not significantly. Most of the wealth, something like 86% of the tax cuts, so the increase in de facto income has gone to the top 1% of the American financial population. The bottom 80% is at best, has been for years, economically stagnant. No increase in disposable income or national wealth. Unemployment for the 18 to 25, I think it is, for the youngest people entering the workforce, is above 8%. And the lag time to seek a job is higher than it has been in years. Those are the elements that would drive an economy. All of them are stagnant and getting worse, other than the rich people who have private airplanes and go to the Met Gala.
The magnificent seven that Glenn has referred to are Alphabet, Amazon, Apple, Meta platforms, Microsoft, Nvidia, and Tesla. So these have cornered the bulk of the economy. These people who own their shares have earned the most. And there is an argument that an entrepreneur was making just before I got on this call, that the balance has shifted between corporates and entrepreneurs. Forget corporates and consumers. Corporates and entrepreneurs, it has become more and more difficult to be an entrepreneur. And importantly, for every economy, just as Glenn said, it is the average consumer. For any economy, whether Germany with its Mittelstand, whether it is here, it is the smaller firms that come up with the innovation, that come up with employment, that come up with the dynamism to the economy. And in some ways, America is becoming, or has become, an oligopolistic economy with very little competition. And that is worrying. And on that note, Glenn, I think we've come, or final words perhaps.
Oh, well, just, 1,000 billionaires cannot buy as many cars as 100 million lower middle class Americans. And if that's the case, and it is, the economy will stagnate if the lower middle class and middle class can't buy them.
On that note, happy Thanksgiving to all our American viewers and happy holidays to all our non-American viewers. We will see you, and on all the best with everything. See you in December.
We'll talk about Kafka next time and find reality.
Indeed. Cheerio.
Join the conversation at Fair Observer and subscribe to our YouTube channel.